Welcome, and thank you for joining us for our webinar today, where we're discussing ASC 606, preparing for the new revenue standards and the technology implications of that particular standard. I'm Ramon Sheffer, one of the presenters today. I'm the Director of Financial Reporting Advisory at HA&W. With me, I have Tom Zolli.
Hi everybody, my name is Tom Zolli. I run sales and marketing for Softracks. I want to thank you for attending and thank you for Ramon for having us here today.
Thanks for being here, Tom, coming all the way from Massachusetts
Sure.
to a warmer part of the country in Atlanta. A few housekeeping items. Today's session is broadcast through webcam. In order for you to activate your webcam so you can see us, you'd have to click on the webcams button at the top of your screen and then click Show All Webcams. In addition, we encourage you to ask questions throughout the session. We'll collect those and we'll have a Q&A at the end of the session. We also have the slides available for you to download. They're under the handout button. If you're interested in receiving CPE credit, you must be on the webinar for at least 50 minutes and answer all 3 polling questions. The final one will be asked after our Q&A session, and all registrants will receive their CPE certificate within 1 week of the webinar. If you have any questions about that, please contact Kayla Harris at the email address that's on the slide. All right, let's get started. So, as I said earlier, today we'll talk about a new standard that governs one of the most important line items in your income statement and overall one of the most important measures by which companies review their performance. We'll start with a technical discussion around the standard, which I'll take care of, and then we'll go into the technology implications of that standard, which Tom will cover, and then we'll end with Q&A. The new standard was issued in May of 2014, but as recent as August 2015, they actually decided on the final effective date. It is a standard that's identical between the FASB and the IASB, making US GAAP and IFRS convergent. Unlike maybe some other areas where we've seen convergence, such as business combinations, we now see with revenue recognition that we're essentially moving away from US GAAP, which is very rules-based and a lot of detailed guidance, to a more principle-based model, which is very much like IFRS today. Whereas it is an improvement over the current IFRS standards, we really see a more significant change for those of us that have been accustomed to applying US GAAP. The effective date of the standard is basically now 2018 for calendar year companies that are public. Private companies, it will basically be 2019. Of course, you have to consider the impact on comparative periods. If you're a public company, you're presenting 3 years of income statement, and if you apply it in 2018, 2016 will be the earliest year that has to be restated in accordance with the new rules. And obviously, that's around the corner. The boards have also allowed an early adoption provision, and that means you can adopt based on the original effective date, which was communicated in May of 2014, which essentially is 2017 for both private and public companies, meaning that 2015 has to be restated for public companies in accordance with the new guidance. Who will be affected by the new guidance? Virtually everyone. Everyone that transfers goods or services to its customers, that are non-financial assets unless those assets are in scope of other standards, such as insurance contracts or lease contracts, for which there are separate standards. The major impacts on the industries are basically listed on slide 6. We definitely see a big impact potentially for software and technology, telecom, media and entertainment, and construction. There is some impact to pharmaceuticals, aerospace and defense, automotive, and retail and consumer. The model is a principle-based model, and it includes 5 steps. I'll go through those. The 5 steps include that a contract has to be identified, or multiple contracts have to be identified with a customer. Multiple contracts may be part of an assessment on how to recognize revenue when they should be combined because they're interdependent. Once that's identified in those contracts, it's required in step 2 to identify the separate performance obligations in the contract. Performance obligations are a new term, but essentially it is similar to what we have grown accustomed to when we say deliverables or element. Anytime a separate good or a service is delivered, whether it's separately priced or not, it will have to be identified as a separate performance obligation. The guidance as a principle to help you identify a performance obligation, and it has to either be sold separately or the user can obtain a benefit from it either on its own or in combination with goods and services obtained elsewhere. Step 3 requires the reporting company to determine the transaction price. The transaction price does now also include variable consideration, which I'll discuss later on. Then in step 4, the allocation of the transaction price will be to the separate performance obligations. That allocation process is different from what we know today. Whereas under US GAAP primarily, we have very restrictive guidance, such as VSOE for software companies, that will limit the opportunity or ability to allocate purchase price, transaction price to separate performance obligations. That concept is no longer in the new standard, therefore allowing more interpretation and potentially more freedom to allocate that price to separate performance obligations. Once that's done, step 5 will require you to recognize revenue when a performance obligation is satisfied. Again, a controls-based requirement and principle-based in nature because it looks at when control transfers of the good or service to the customer. There is no longer a checklist approach to revenue recognition. The key takeaways are that revenue will potentially be accelerated in recognition. The reason for that is a lot of the restrictions that some of these industries have been working with in the past couple of decades will be gone. As I said earlier, VSOE is no longer a requirement. Also, collectability may not have to be considered the same way and can be measured into the transaction price. Variable consideration will be pulled forward as well because a price does not need to be fixed and determined anymore or determinable as it was required under the old rules. That means that when there's a performance bonus, for example, or any form of discount or rebate, an estimation has to happen based on which the company can be comfortable that based on historic experience they can recognize that revenue. And a company doesn't need to wait any longer to recognize the variable component until the contingency has actually been resolved. The other issues that are important to note is that contract acquisition costs, such as sales commissions, are now required to be capitalized and amortized over a term that corresponds with when the customer expects to be generating revenue for the company. Furthermore, time value of money is important when there are significant effects from differences in the time between when a deliverable or a performance obligation is satisfied and when payment is received. When there are significant upfront payments or significant payments in arrears, that needs to be considered because the boards require you to recognize the interest, either expense or income, as it relates to that effect. Furthermore, additional disclosure requirements are included in the standard. As you know from experience, the disclosures currently on revenue recognition are not very elaborate. But with this new standard, the boards have finally made a decision to include a lot more information as it relates to revenue contracts. In order to adopt the standard, the boards have given reporting companies two methods. First, the fully retrospective method. That one is probably the easiest to understand because it just requires, like most standards, a fully retrospective adoption. Meaning, if I have to be effective as of 2018 and I have 2016 and 17 as comparative periods, I have to adopt a standard and show all of my results for all 3 years in accordance with the new standard. If you're a calendar year company, that means your opening balance sheet under the new rules is January 1st, 2016. The boards acknowledged that that could require a lot of effort, and so they gave the companies a practical expedient in the modified retrospective method. The modified retrospective method requires that 2018 is completely reported in accordance with ASC 606, meaning the opening balance sheet for a calendar year company will be 1/1/18, and 2016 and 17 are reported and included in those financials based on the prior standard. However, with the modified retrospective method, there is a requirement to disclose the impact of the new standard to those comparative years. So one could debate if there's really a big impact or benefit to be gained from the modified retrospective method. However, consider the fact that disclosures are different than actually adjusting the face of the financial statements. So we have some advice as a result of talking to many companies that have started to look at this new standard. Obviously, this is a pervasive and broad impact type of initiative, and therefore we say we think companies should look at this from a multidisciplinary perspective. If a project plan is put together, it should probably be put together now, including a timeline for adoption. The more significant the impact might be to your company, the earlier you should start. We recommend a steering committee that basically governs the entire adoption. That should include your sales force, accounting, reporting, legal, IT, tax, and investor relations. What we would recommend is that you assess the potential impact of the standard by doing a review of your contracts in accordance with the new standard compared to how they were accounted for under the old standard, quantify the impact, select your adoption method, whether it's full retro or modified retro, and quantify the resource needs both from an internal and external perspective. The other thing that's important is that this is entirely new and impacts your organization from a multidisciplinary perspective, and therefore we recommend a good training program to be set up for awareness and to arm your folks with the ability to really assess the impact from a quality perspective. Furthermore, developing a communication strategy for your company would be a strong recommendation as well, as you're communicating with those that use your financial statements, including your auditor. Describing what the potential impact might be and informing those, including analysts, on what the expectation is. Last but definitely not least is you realize there's a data requirement, and the question becomes, where was your data before the new standard, and what does it need to look like with the new standard? As I described earlier, you have to potentially restate prior years. You may have to deal with the new standard and the old standard simultaneously for other reasons as well, such as debt covenants or income tax reasons. Therefore, we think it's important that technology needs to be considered. And I've basically got Tom here to highlight what Softracks can do in that particular area. Before we turn to Tom, we have the first polling question up, and I will read it to you. You can select from the menu which answer applies to you. The question is, how far along is your company with the implementation of the new ASC 606 standard? A, you haven't begun the impact assessment. B, you completed the impact assessment, but you're currently in the implementation phase, which includes drafting policies and considering system modifications. C, you're ready. You're ready to implement and adopt, either as of effective date, or you might even early adopt. D, you're unsure, and E is not applicable. Tom, as we wait for those results to come in, what have you seen sort of when you go out and talk to clients about how they're looking at technology in light of ASC 606?
Sure. I think that if you asked me 6 months ago, are people paying serious consideration ASC 606, I think the answer would have been no. I think if you look at it right now, you're starting to see the acceleration of attention in it. We've done our first deployments that have been specifically around 606, but as far as the mainstream and attacking it, it's still yet to come. So.
Yeah, I think some of that has to do with how the boards have looked at the standard, received comments on it, revised the standard,
yep.
Definitely got rid of some of the more controversial aspects, and then also gave everybody an extra year to adopt. And that was as recent as August of this year, where they actually revised the effective date.
Yeah, and I would add, I would say the sense I got from the community was that there was a time when they thought there was going to be a 2-year delay in the standard. And I think people thought they had more time. I think a lot of people were surprised when it was a 1-year delay, and I think
right.
people are starting to hop to it. So.
Yeah, I think the boards have acknowledged it takes more time than maybe they've originally envisioned. And of course, there are conflicting priorities for a lot of companies, and this will impact one of the most important items in their financial statements.
No question.
I think people are still responding, but as it looks right now, I can see the percentages here. We have 50% of the participants that haven't begun the impact assessment. 23% completed the impact assessment and are currently in implementation. 3% are ready to implement and adopt. 15% is unsure, and 9% is not applicable. So this sort of seems consistent with what we talked about. People are really starting to familiarize themselves with the standard, and I think now is the time to really start doing something.
To jump in, yeah.
So with that, Tom, tell us a bit more about Softracks and the technology considerations around the new standard.
Sure. So many of you are probably familiar with Softracks. We've been involved in complex revenue recognition from a solution provider perspective for a number of years, doing implementations in the order of hundreds anyway. What we wanted to talk about today was, from a vendor perspective, what do we see as sort of the risk factors first, and just any general implementation of this kind of technology. Then we want to take it a step further and talk about, what are the additional risks inherent in ASC 606 that people may or may not be thinking about. And then let's look at the timeline and the consideration. We want to focus a little bit on what we've been calling the look back. So, as you know, companies have some time before they actually have to report on this stuff. The issue is the longer that you wait, the more you're going to have to look back and process contracts from before. And there's some tricky issues there. So we'll get into that. So why don't we jump in? So let's just talk about a general case, and there might be some surprises here for the community. When we approach projects, far and away from our history, our background, the number one delay factor, at least in terms of calendar time for an implementation, believe it or not, is our resources on the client side. So now, financial professionals now are very busy people. They've got month-end close, quarterly close, year-end close. They have budgeting, they have audit, they have other projects going on. Our rule of thumb is if we get 10 days a month from these people to assist in the implementation, and then let's face it, they're required for a successful implementation, right? We can't do it ourselves. We're happy with that, okay? The other thing that I think is important to consider with these implementations is you're talking, especially when you talk about complex revenue recognition, you're talking about a very limited vendor community. There are just not a lot of companies out there that can handle this stuff. And so there's an issue of the resources that they will have available as the masses come on board and need to get this work done. Second, I would say, are these data migration issues. And I'll talk a little bit more specific to ASC 606, but just in a general implementation, you have to keep in mind that it's like trying to jump onto a moving train. So when we come into an organization, we're trying to get the system ready to process your transactions, but included in that are all the open contracts, right? Mm-hmm. So what is all the historical data that we have to load in to prepare things? And we, like the other vendors in the community, and we provide things like data migration toolkits, load templates to assist with this. But it's a bit of work. Now, what I would say is if you're a company that's grown through acquisition, or if you're a company that has long-running contracts, when you get down to the technical detail of implementation, those are things to think about. Those are things that might increase your risk. They might increase the length of time for the implementation, the amount of human involvement in the implementation. The next thing I would say, sort of third priority, is business complexity. So, RevRec, many different industries, many different sets of challenges. Some of it is very, very simple. It's all upfront and total. Some of it is extremely complex. So the third thing we look at is how complex is this business? So if you sell things many different ways, it's going to increase any implementation, ASC 606 or before. If you are doing things like complex allocations, carves, the Internet of Things is a very popular vertical right now. Unfortunately, it has some of the most complex RevRec we've seen in terms of requirements for multi-step allocation, et cetera. So something to think about when you're thinking about, how much time do I have to get this done? Believe it or not, the fourth on the list, and many people would think it's higher up, but it's actually become less and less of an issue. It's still there, but less of an issue, are the integration issues. Now, there's a lot of options out there. If you're going to do it with an automated solution, most likely you're going to want to leverage some sort of a web service API to link the systems up. All very doable. It's very stable technology. I would say if you're of the ilk where you have multiple systems to integrate with, and again, companies that have grown through acquisition, we see that as being a common one. I would consider that, and consider that as a potential delay factor. And then finally, a big chunk of time is obviously spent in the test. This is your revenue data. It has to be perfect. If you have, a very broad revenue policy, if you sell things many different ways, many different use cases, those are things to look at. These were all things that we think about in doing any implementation outside of 606. So now let's dive into 606 a little bit here and see some of the new stuff. One of the obvious ones is the requirement to dual report. I think of all the things that we see within ASC 606, this might be one of the easier ones. I think if you're trying to get it done with Excel, or you're trying to get it done with a custom solution, maybe more of a challenge. Reporting out of Excel in general, it can be a very painful thing. Now double that effectively, right? So it can be a problem. Once you get to the point of having your data into a structured database and into an automated solution, I think you'll find that there are options on the market to handle the dual reporting. It's really going to be getting there. The only thing I would call out is something to pay attention to is the reconciliation process. So Is this going to double your reconciliation activities, etc.
Yeah, I think I'd like to mention here too, as from a technical accounting perspective, we saw earlier that you have to restate prior years or you have to assess the impact and disclose such.
Right.
So you're continuing on with old GAAP for 16 and 17 and then adopting new GAAP in 18 if you're public. Probably the most efficient way to do that is to enter it once, if you will,
sure.
right? And so you have a system that does the old numbers essentially and creates journal entries according to the old rules, but simultaneously you basically produce the results in accordance with the new standard. Of course, you can go back and try and fix it after the fact, but that might not be the most efficient. Furthermore, as I stated earlier, we were just meeting with one of the major banks in this area, and they were talking about how companies have to report for debt covenant purposes. And a lot of times the basis is U.S. GAAP, and it's U.S. GAAP as we know today.
Right.
So if you have a new standard, and revenue is obviously important, it has an impact on EBITDA. Think about valuation as well. It's another thing to think about as you have models that are based on earnings, EBITDA, revenue, obviously a factor. What will you do with the fact that your revenue is going to change year over year because of this new standard? Now, you may want to continue to report under old GAAP, or you adopt the new standard and also report for compliance purposes on new GAAP. Those things are things to be considered, and what is basically the best decision based on a cost-benefit analysis.
Yeah.
And then thirdly, with tax, I'm not a tax expert, but as I work with tax colleagues, for revenue recognition, there's a method election to make, and you can actually make book accounting align itself with tax.
Mm-hmm.
But if you know that revenue essentially will be accelerated, the question will then be for book, right, will you want to do the same thing for tax, triggering an additional tax liability that will have to be settled earlier. If you don't, then still you have a requirement to keep reporting on old basis or tax basis, and then you've got book that's based on the new rules. Mm-hmm. All sorts of things to work through and to assess and consider the benefit you might gain from having a good technology solution.
Yeah, for sure. And I would say from a technology vendor perspective, we would much rather see people adopt what we would call proactively rather than reactively with the look back. I think unfortunately right now it's a situation where in some cases it's too late to be perfectly proactive.
Right.
We'll point out some of the things that get more complex as you have to do the look back. I think one of the major points we're trying to bring to the market is the more you can control how much of a look back you have to do, the quicker you can get to adoption, the better off you're going to be.
Sure.
All good points. So why don't we talk a little bit more about some of the nuances of ASC 606. One of the big tenets is separation of performance obligations. There's a lot that goes on with it. From a technology vendor point of view, people that have to implement, one thing to understand here is if you look at the way we've done what we would call the migration of historical data, meaning the existing open contract as we're trying to implement and go live, we bring tools to bear, right? We talk about like data migration toolkits and load templates. Interestingly, in the current guidance, it's a one-to-one thing in a sense. What we're trying to do is understand what the contract is, what the elements of the contract are, and they're loaded up on basically a one-to-one basis into the database, if you will. Bring in the separation of performance obligations, the question becomes, is this now going to be one-to-one with these line items? Could a single line item now be two? Could two be one, et cetera, et cetera? Can be done, of course. The question will be, and you'll hear this pervasively throughout this part of the presentation, but is it being done, the separation of performance obligations, is it done in a standard way or a non-standard way? Standard things we as technology vendors can automate, non-standard not so much. That increases the effort on your team. The question is, you have a number of people loading in contracts right now just to keep up with US GAAP. How much does that increase as you have to deal with ASC 606 and do the look back? So something to think about. The next one we talk about is variable consideration. It's one of the main tenets of the new guidance. From a technology provider perspective, I think that all doable in an automated manner, at least for the standard stuff. So, I mean, basically, with variable consideration, you're looking at the amount of revenue that you have in total, and you're determining amount that you may have to hold back. Now, one thing I think that you could assess as you're looking at the complexity of this is this going to be a consistent thing for me? So if it's, you know, for this SKU, I receive this much, and I always hold back this much or this percentage. I will say there are vendors on the market that can do this. I would say there's not a huge number of them, which this now starts to push people into a smaller and smaller pool, but can be done. I think what you need to assess, though, is this standard or is it non-standard? So the standard stuff, set up the rules, can be taken care of. The stuff that is non-standard, you're going to have people look at this stuff. And it's very hard in a lot of these issues. It's hard to rely on your technology vendor to do this because they just don't know your data. It's hard to bring in people from outside because they just don't know your data. So keep that in mind as you're looking at your resource plan, etc.
And if I may, Tom, just to illustrate this further for those that just may have started looking at this new standard, in case you have a long-term contract, whether you're a software company that's implementing something or you're a construction company trying to build a bridge, for example, if you get paid $2 million while you're implementing, and if you get done with the project before a certain date, there's an additional $1 million to be received from your customer. In the past, you had to basically wait until an event happened, the condition for which you would be able to collect that $1 million performance payment, if you will. Mm-hmm. Under the new rules, you basically are required to record that earlier if you have enough historic experience to estimate the likelihood of you collecting that additional $1 million. This makes it obviously sort of one reason why we believe revenue will be accelerated. Mm-hmm. And I think, again, if you have thousands of those type of contracts, that's where technology becomes a potential solution to this type of issue.
Yeah, for sure, for sure. Another one is time value of money, and you know, I would put this one in the category of just allocations and determining you know, the fair values themselves as well. And I talk about this specifically around the look back in this case. So, you know, any time where you have to synchronize multiple things in time, and time value of money, basically you've got the recognition events, you've got the payment events, and now you've got this discount rate. And so imagine you're looking back across 2 years, you're trying to load up this historical data, and you're effectively trying to walk the revenue forward. Well, you have to make sure you walk that forward in sync with these changing elements. Similar story if you're doing, if your business is of the type where you have to allocate among elements in a multi-element arrangement. If you're loading up historical contracts and trying to walk that forward in a new technology preparing to go live, you have to make sure that you're using the appropriate fair values that were determined off of the appropriate data sets to coincide with the time at which the allocation is occurring. So there's all of these synchronization issues that need to occur. Not rocket science, very doable, but the longer of the look back period you have, if you have these kinds of issues, the more work you're going to have to do and the more synchronization.
And again, on this one, I think the boards have really acknowledged that if you get paid up front or in arrears, it's a financing transaction if there's a significant amount of time. I think they would work with about a year to define significance between delivery and payment. Mm-hmm. Basically, the sort of unusual impact is that if you get paid in arrears, you basically have loaned money to your customer, and you can generate interest income. And so the total amount of revenue recognized could be in excess of the total payment that you receive from your customer. So revenue could be higher than what you were recognizing in the past. If you get paid up front, you will have to deal with interest expense. Anytime there's differences between payment and delivery, there will be a potential impact from this discounting effect. And if you have, again, thousands of contracts, it's going to be really hard to figure this out manually. And therefore a system, a solution will actually help with this. The other thing I'd like to say is that some of my clients have said, well, it might not be material because the time between the delivery and payment is not significant. Well, I think most of the companies I talk to also have an auditor. and the auditor is going to have to get comfortable with the way you've assessed the impact of the new standard. Again, how are you going to prove out that it is insignificant?
Right.
And if you've got a high volume of contracts, Excel might not work. It might or it might not. But again, consider a potential solution like a Softracks to figure out the answer, I would say.
Mm-hmm. Okay. Thank you for that. The next one is disclosures. I mean, obviously, it's being talked about in the new standard quite a bit. This one, I think, falls into the category of standard or non-standard. So, you know, within most of the automation solutions on the market, there's an option, usually, you know, wrapped around some sort of a mapping technology that allows you to tie standard disclosures to particular transactions. Again, it's a situation, if you're looking to do this in an automated manner, it does put you into a smaller pool of technology providers, but it is out there. I think one of the things to weigh, though, is how much of your disclosure activity is going to be due to non-standard transactions. How much are you going to have to manually touch? If you see that getting very large, then you know it's something where you're going to there's no way around it. You're going to have to invest the resources that know the data to do the work, basically. So it's one more thing out of ASC 606 to assess, you know, particularly as you're trying to decide when am I going to go live here. You know, how much of a look back am I going to do? All this work gets larger and larger the greater the look back. So we can probably talk about that next, actually. So, you know, this is very broad brush, obviously, and I will say that, you know, the vendor community, along with the user community and the auditors and everybody, I mean, this is all very new to everybody, and we're learning as we go here. But, you know, for the reasons that we described, we think that waiting till the 11th hour, or let's say the 11th or 23rd month, to begin your live portion of your ASC 606 strategy is as close to untenable as you could get. Now, I will caveat that by saying, you know, we deal with more of the complex rec scenarios. There's some people that probably won't be affected at all by the new guidance, and you may have a better out there. But if you feel like you have some of the complexities that we described in these previous slides, maybe you've grown through acquisition, so data's in many different systems, long-running contracts, you know, just complex allocations, things like that. I think that's where you really need to look at the left hand of the band here, and you know, it's probably too late at this point. You know, unless you've started already and are very close, it's probably too late to get through an implementation by January 1. But you know, the question is, where will you be? Are you going to be at the end of Q1? Are you going to be at the end of Q1 next year? How much, you know, risk do you want to tolerate, and how much work do you want to do at the 11th hour? From a vendor perspective, I will say that for people that are moderate and higher complexity, we think now is the time to get going. So.
Yeah, and I guess to this point, real quick, I mean, some companies say, look, I had very rules-based guidance, and it was very restrictive, but now we've got this principle, sort of broad standard, and why wouldn't I be able to just continue to do what I'm doing under the new rules with the old policies that I have? And I would say this, I've talked to companies that, because of this broader definition of a performance obligation, found themselves identifying additional deliverables, such as, you know, if you have a design, but you also have implementation, and you may have publishing, and that used to all be bundled up into one, and you charged one price. Now somebody might say, well, you know what, there's a potential for 3 deliverables, and they're all delivered at different times. Yep. You don't have to have VSOE, and now you can estimate the selling price even though you never sell any of those 3 separately. And estimating selling price is coming up with potentially a cost, as you've incurred it to be able to deliver it, plus a reasonable margin. So now we have an estimation process and a requirement to separate and then recognize as well. Think about the impact of that and the benefit of using something to help you track those.
Yeah, exactly. So in terms of options, we'll just go through this quickly. I mean, you know, one option is obviously just to do a whole system replacement. Some people call it a rip and replace of an ERP system. Another option is to go, you know, sort of a semi-manual route around custom coding or spreadsheets. We at Softracks, in a handful of vendors in our space, I mean, we approach it from an ERP augmentation perspective, which is basically to say, keep your existing systems in place, minimize the disruption, and just fill the gap regarding RevRec. So let's talk a little bit about these three options. As far as the whole system replacement, I think if you'd started a couple of years ago, you'd have plenty of time, maybe even last year. If you're looking to do it right now and you have a complex business, very tough. You can see some of the statistics here and the time it takes. It's always more disruptive, more costly, more risky than people expect. So probably not a great option. Next one. Spreadsheets. The one thing I will say about spreadsheets, they're risky. People, Excel is a wonderful tool. I do think that some of the people I talk to are using spreadsheets, and it's providing value because it's forcing them to go sort of contract by contract and get into the depth and the detail of the new guidance. The caution I would have, a lot of these people are doing this as sort of a prototype effort. We in the technology community know better than anybody the risk of the prototype becoming the product, right? So, I would have a definite plan for when you're going to switch off spreadsheets, and if you're a very complex business, you may just want to skip that step. So the next option is ERP Augmentation, and sort of just a short blurb on Softracks. We have a product called Revenue Manager that's designed to plug into whatever ERP system you have. We support all of the major ones. It's probably the least disruptive thing you can do. We've been very good at honing our implementation process. So what we'll do is we'll take feeds from your upstream systems, whether it's order data or invoice data, and we will act as a revenue subledger. So we'll handle all the allocation, all the scheduling. We'll work according to the old guidance and the new guidance. We'll handle the dual reporting. At the end of the day, in addition to all the reporting, the support for audit, we're pushing journal entries back to your general ledger.
So could you say that, I've heard the term used, that you might be considered a bolt-on, essentially?
Exactly. Yeah, we use that term ourselves. So
got it.
A bolt-on to the existing ERP.
So keep what you've got, whether it's Oracle or SAP, but Softracks is something they could add on to make, the revenue recognition work in accordance with the new rules.
Yeah, I think two advantages. One, it gets you there very quickly, which I think is good. The other thing is that these are best of breed products, right? So, it's something you can put in. We specialize in revenue recognition. If your needs change over time, we've got the power there. It's probably something you will never have to take out. So,
right.
So with that, why don't we move on to the second polling question, which I can barely read from here. Oh yeah, all right, that's good. So, please select as we go. So the question is, which of the following aspects of ASC 606 are you most concerned with? Option A, identifying, tracking, and measuring the additional performance obligations, including estimated selling price. B, capitalizing and amortizing contract acquisition costs. C, accounting for the time value of money. Or D, the organizational impact of ASC 606 in regards to, as Ramon mentioned, your investor relations, your debt covenants, IT, the tax issue, etc. Or E, unsure.
As those results come in, we basically have been following the standard since 2008. I continue to see these items come up as items that companies are concerned with. I do think that the boards have listened to a lot of the concerns, and even to this day, they just recently issued another instruction to the staff to go back to the drawing board on collectability and some other items.
Yeah.
Collectability has been a concern because the board sort of let go it being a recognition threshold in the past, as in if you couldn't reasonably assure collectability, you couldn't recognize, and you had to get assurance as it relates to collectability before you could recognize. So you defer. A lot of our clients, and we have a lot of them at HA&W that are sort of startup and they're very cutting edge software companies, might also deliver to companies that are sort of startup and cutting edge, and they might not get a significant amount of credit. And so when you set your credit limit at a number but the total contract price is higher, this created the concern that you could only recognize initially based on the credit limit you prescribed to that customer. And so the boards have gone back and they're now working on something that hopefully will be more practical to apply.
Yep.
So with the results sort of coming in here, I think that it's good to know that at this point we have 41% that's concerned with the identification, tracking, and measuring of additional performance obligations. So it's by far the majority. 18%, which is concerned with capitalizing and amortizing contract acquisition costs. 11% concerned with the time value of money requirement, and then we have 10% concerned with the organizational impact, and 22% is unsure. Again, you know, as you go through the impact assessment, you might be able to get a bit more sure about what the impact is you're going to spend the most time with. I would have to say from experience in doing a lot of IFRS conversion work in the past, I've seen that the organizational impact could actually be more daunting than sometimes just technical accounting. And to illustrate this, it's basically focused on, well, how do you communicate your numbers and what do you use the numbers for? And revenue being so important that you might not have completely considered how this is going to trickle down into the organization. Think about how you compensate your sales force, for example.
Yep.
All those guys get paid on commission in a lot of cases, and they would like to recognize as quickly as possible so they can get enough money for the holidays, for example. Now the question becomes, will this new standard accelerate the revenue, and is that the impact I want to have on the compensation of my sales force? There are obviously other things to consider as it relates to communicating with analysts, with your bank, and of course technology, as you highlighted, Tom. Forget a new standard for a moment. You know that an IT implementation will take a lot of time. Potentially will go over budget, potentially, or may not meet the deadlines that you set from the onset. And so managing that carefully is definitely a recommendation I have for my clients.
Yeah, and you're right there. I mean, from a technology vendor or an implementer perspective, all the things you mentioned, I mean, the last thing that we want to do in these implementations is come in and scope them and then see significant change in requirements, you know, that might be driven by some of these communication aspects in the middle of it. So, you know, to the extent people can get these issues sorted out before we get there, very good thing. On the other hand, you can't tread water forever. At some point, you have to jump in.
Yeah, so. Right. And that sort of concludes question number 2. I think we can now sort of look at what questions may have come in, and I'd like to reemphasize that we might not be able to address all of them in this session. We have about 10 minutes left at this point, but our contact information is up on slide 25. And if your question was not addressed, and obviously we have a collection of them, we'll try to reach out to you. Also, feel free to reach out to us if your question could not be submitted, or if you have any additional questions that you did not want to submit but did want to talk to us about specifically. We're more than happy to help you. This is important to us, and we're focused on it 24/7. So with that, Kayla, you have a few questions that came through.
Yep, we had a few questions from the audience. Let's start with, have you seen companies actually take steps for ASC 606 implementation?
Yes, I have, and I think, Tom, you have as well.
Yeah, I would say that the big press has not occurred yet. We haven't seen the masses drive implementation, but it's been very interesting for us. As a vendor, we deal with complexity in RevRec, so a lot of our implementations have been around the technology vertical, some of the other related ones. Interestingly, the telecom and cable industry, because specifically of the new guidance, they're starting to move into an area of complexity and revenue recognition, and they in fact have been some of our earliest implementations that were driven specifically by ASC 606.
Yeah, what I'd want to say is that those of our clients that are public, that are of significant size with a decent amount of staff on board, have actually really, you know, been working on this for about a year or sometimes longer, have already started going down the path of implementing or assessing a technology solution and making a selection, and those are be at the top end as far as size and sophistication. Then there are a lot of companies sort of in the middle, and they've now started to begin a project and assessing it, and they're interested in talking more about it. And we offer our 2-hour free CPE at the clients to specify both a training but also an assessment at the same time of where we think the pain points will be for those companies. And then there's a whole host of those that are entrepreneurial companies, extremely energetic in the market, but they're obviously focused on generating revenue and growth, and they may not focus as much on accounting and compliance. And so those we're seeing that they're just now starting to get familiar with it, but you know, we'll hope that those get on board and reach out for help if they need it as soon as possible.
Okay, thank you guys. Here's another one. If you have Oracle, SAP, or any other ERP system, why would you need to consider bolt-on solutions like Softracks?
So from our perspective, it really comes down to a question of the complexity of your revenue recognition. So the key things to think about are, you know, if you're doing everything in the system today, you have the security, the access controls, you have the audit, you have the reporting, you probably don't need a bolt-on solution. The only caveat to that would be the new guidance, right? If you feel like the new guidance is going to force you out of that system into some manual work, then you should certainly consider it. Now, we find, you know, there's varying levels of abilities in the ERP solutions to handle RevRec natively. You know, today's market, you don't have to get too complex before you're beyond the capabilities of the solution. So when we go out across the market and look at people that are likely candidates, I mean, we're looking to see people doing things on spreadsheets, or people that have built custom solutions. I mean, people have massive investments in custom solutions that they're now facing a major compelling event with ASC 606. Do I double down and rewrite the code and support really 2 sets of code, or do I take the plunge, pull it out, put a productized solution in? I mean, the value we provide to the market is it's the same bits deployed to hundreds of people, stable, it's been tested through time, very low maintenance, it's multi-tenant SaaS or on-prem. So, you know, that's how we would address that question.
I also think that from talking to my clients that consider a Softracks as a solution, it sounds like it might be more customizable and flexible compared to some of the resident ERP environments and systems. Is that right?
Yeah, for sure. For sure. It's designed specifically for that. Yeah.
I think we have time for one more before we jump into the last polling question. How does ASC 606 impact internal controls?
Yeah, that's always an interesting one, and of course that's more relevant for our public clients with regard to Sarbanes-Oxley. You know, you'll see an increase in the auditors' requirements, if you will, to figure out how well the company is doing from an internal control perspective. I look at it this way. Having worked in Europe where, you know, the world of sort of principle-based accounting has been there a bit longer than in the U.S., if you will, in recent times. Everything always started with a principle, but IFRS is really focused on becoming that sort of standard. I saw a lot of policy writing by companies over in Europe to define what it means for a company when it says, you know, reflect the economics of the transaction, or how many performance obligations are there and how do we define those for our business. And the boards really did want to put the burden on the company to define what their business is, what were they selling, what's the substance of the transaction. Now, you can already see, having been an auditor myself way back, I basically always ask my clients the question, so how have you dealt with this guidance, and what does this really mean from a policy perspective? Can you prove to me that you've applied it correctly? So again, a lot of work to be done, and all those policies will essentially sort of roll into an internal controls environment where you can point to, okay, this person did that and that person reviewed it. And of course, not to forget the technology or the system component as it relates to controls as well, right?
Yeah, for sure, for sure.
So we have a third and final polling question, and the question is, how do you prepare how do you plan to prepare your IT solutions for the new guidance? And we recognize that some of this might have just come to you first time you're hearing this, and you may not really have thought about it, but we definitely want you to try to answer this the best you can. So question number one, or answer number one would be, there's no need to prepare, you have it fully covered. Question or answer B would be, current ERP and or revenue system will need modification. C, you're planning to use a manual workaround like spreadsheets. America runs on Excel, right?
For sure.
D, we'll need to implement an entirely new technology solution. And E, it's unsure, you're unsure. And I think, as those results come in, I think with D, when you actually conclude you need an entirely new technology solution, obviously, the turnaround time, lead time that you need to get that in place is going to be longer than, if you had to just tweak something or modify your existing environment or consider a bolt-on, if you will.
Yeah, I mean, I think our main message to the market right now is, assess what's going to be required. Don't wait to start the assessment until the end of the period and do the full look back, because you don't know what you don't know at this point. Even as technology vendors, we don't know what we don't know at this point, right? So the world has to go through many of these implementations, but we tried to call out today some of the things that concern us, as the vendor, in terms of what could add hours effort to the thing. The attendees are probably far better shape to understand it themselves, knowing their business, but definitely something to look at now, at least to check the box.
So we're looking at those results, and it looks like 8% has answered that there's no need to prepare and you're fully covered. It's actually up to 9 now at this point. 9% has said such. For the current ERP and the current or the current revenue system to need modification, 34%, which is the majority besides the unsure answer, thinks there's a need for modification, so that's B. C, 11% answered that planning to use a manual workaround is definitely a consideration at this point, and 8% has said that they will need to implement an entirely new technology solution, with 39% unsure, which may just further emphasize the need to do a bit more work to assess what impact you are expecting, and then compare that to, well, where's my data, and how do I support a potential adjustment, and do I need a technology solution to address that?
Exactly.
So I think, are we up on time? So we really would like to thank you for joining us, and I would like to also say that the results of the polling questions, as well as questions that were asked and what we discussed, will be distributed in an article. We will also make this webcast available for archive, so you can share it with your friends and colleagues and family if you want to, and we look forward to seeing you again soon.
Okay, thank you, everybody.